Hey everyone, welcome back to Corporate Decoder. Today's CIBC Retirement Savings Plan for us employees just filed its annual report, and I am seeing a huge focus on investment growth. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing details how millions of dollars are managed within the retirement plan, with a massive chunk tied up in various investment accounts. So we are diving into the annual report for the CIBC Retirement Savings Plan for us employees. This document, filed with the Securities and Exchange Commission, gives us a look under the hood at how this retirement plan is managed, especially its investments. It is for the fiscal year that ended on the 31st of December 2025. Think of it like a yearly checkup for the plan's finances, showing where the money is and how it performed. The big takeaway here is that this plan is governed by ERISA, a law designed to protect people with retirement plans. It means they have to be pretty transparent about their finances and how they are handling the money. First up, we have the report of independent registered public accounting firm. This is basically an auditor giving their stamp of approval. Ernst & Young LLP audited the financial statements and declared that in their professional opinion, the financial statements present fairly, in all material respects, the net assets available for benefits of the plan. This is good news. It means the numbers we are about to see are reliable and prepared according to generally accepted accounting principles in the US. Now, let us get to the juicy part, the financial statements. The statements of net assets available for benefits show us the plan's financial health at a specific point in time. As of the 31st of December 2025, the total net assets available for benefits stood at a massive $1,347,796,432. That is over $1.3 billion. Comparing this to the previous year, the 31st of December 2024, where the net assets were $1,116,333,096, we see a significant increase of over $231 million. This represents a growth of roughly 20.7% year over year, which is a very strong performance. The largest asset by far is investments. In 2025, these were valued at $1,332,135,586. In 2024, that number was $1,104,311,071. This 20.6% increase in investment value mirrors the overall growth in net assets, indicating that the investments themselves are performing well. We also see notes receivable from participants, which are basically loans given to plan participants. In 2025, these totaled $6,528,682, up from $5,597,603 in 2024. This increase of about 16.6% suggests more people are taking out loans from their retirement savings, which can be a double-edged sword. While it provides immediate liquidity for participants, it also means that money is not growing within the retirement account. Employer contributions receivable also saw an increase from $6,424,422 in 2024 to $7,420,160 in 2025. This is a healthy sign for the plan. Next, we have the statement of changes in net assets available for benefits for the year ended the 31st of December 2025. This statement shows us how the plan's net assets grew or shrank over the year. The total additions to net assets were a substantial $305,852,386. The biggest driver of this growth was investment income, specifically the net appreciation in the fair value of investments, which was $150,190,233. This means the investments within the plan grew significantly in value during 2025. Add to that $40,565,253 in interest and dividend income, and you have a total net investment income of $190,755,486. This is a very strong return on the plan's investments. Contributions played a huge role too. Participants contributed $59,155,736. Employers added $38,596,114. And there were $16,770,724 in rollover contributions. That brings the total contributions to $114,522,574. When you combine investment gains and contributions, the plan had excellent inflows. On the other side, deductions from net assets, the most significant chunk was benefit payments to participants, totaling $74,005,338. Administrative expenses were relatively small at $279,191. The net result was a strong increase of $231,463,336 in the plan's net assets for the year, bringing the year-end total to that impressive $1.34 billion. The notes to the financial statements provide crucial context. Under the description of plan section, we learn that this is a defined contribution 401k profit sharing plan for eligible US employees of Canadian Imperial Bank of Commerce. Or CBC, it is administered by a committee, and the trustee is Vanguard Fiduciary Trust Company. Participants can contribute a good portion of their earnings, and the company matches contributions up to 6% of eligible earnings. This matching is a great incentive for employees to save. There are also provisions for catch-up contributions for those aged 50 and older, and even more for those aged 60 and above starting in 2025. Rollover contributions are also accepted, allowing participants to consolidate retirement funds from other plans. A key feature for participants is their ability to direct their own investments. They can choose from various investment options and make changes daily. This flexibility empowers participants to manage their retirement savings according to their own risk tolerance and goals. For those automatically enrolled, their money goes into a life cycle fund based on their age, which automatically adjusts its investment mix over time. This section explains how the plan values its investments. They use a fair value hierarchy, prioritizing unadjusted quoted prices in active markets as the most reliable. Level 2 inputs are typically observable for similar assets or derived from observable market data. Level 3 inputs are unobservable and used when market data is scarce. The vast majority of the plan's investments fall into the level 1 category. This means they are valued based on unadjusted quoted prices in active markets, which is the gold standard for investment valuation. Looking at the fair value tables as of the 31st of December 2025, we see that registered investment companies are valued at $788,012,635 and common collective trusts at $482,754,742. Both of these categories are predominantly level 1 assets, meaning their value is determined by readily available market prices. This is excellent, as it signifies transparency and liquidity in the investments. The CIBC stock fund, which includes CPC common stock, is also valued at $61,082,999. This is also a level 1 asset, meaning it is valued at the closing price on the market where it is traded. This section addresses transactions involving parties related to the plan, like the trustee or its affiliates. The plan invests in mutual funds managed by the trustee or its affiliates, and also in the CIBC stock fund. These are considered permitted party in interest transactions, meaning they are allowed under ERISA rules because they are covered by exemptions. This is common in retirement plans and usually doesn't pose a problem if properly disclosed and managed. The plan invests in common stock of CIBC through its CIBC stock fund. It is important to note that participants in possession of material non-public information about CIBC are prohibited from making changes to their CIBC common stock investments. Also, during certain trading blackout periods, participants can only make changes during open window periods. This is a standard compliance measure to prevent insider trading. The plan has a favorable tax status. It received a determination letter from the IRS in August 2017 stating that the plan is qualified under Section 401 of the Internal Revenue Code. This essentially means the trust is exempt from taxation, which is crucial for maximizing retirement savings. The plan administrator believes the plan is operating in compliance with tax laws. Here, they acknowledge that the plan invests in various securities primarily based on participant elections. Like all investments, these are exposed to risks such as interest rate changes, credit risks, and overall market volatility. The filing warns that changes in the value of these investment securities could materially affect participants' account balances and the reported net assets. This is a standard disclosure and a reminder that no investment is risk-free. Finally, we have the schedule of assets held at end of year. This is a detailed list of the plan's holdings as of the 31st of December 2025. It breaks down the investments by category and shows the current value of each. You can see a long list of registered investment companies and common collective trusts. For instance, the Vanguard Institutional Index Fund Instel Plus shares had a value of $259,541,475, and the Vanguard Target Retirement 2030 Trust I was valued at $66,678,604. The CIBC stock fund holdings are listed here as well. This schedule provides a granular view of where the plan's massive investment portfolio is allocated. Looking at the overall picture, this filing shows a retirement plan with substantial assets that have experienced strong growth in 2025, driven by solid investment performance and consistent contributions. The plan is well managed and compliant with regulations. The increased participant loans are a point to watch, but the strong investment returns are the story here. What I'm actually looking for is how this investment performance translates into long-term security for the participants. Alright, that is our breakdown of this retirement plan's annual filing. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.